First of all, so I'm Ryan.garbett, I'm from Private Finance. We've got an office in little old Shropshire, and then our head office is down in central London. We're a whole of market mortgage broker, so every single lender you can imagine we deal with. So we're something called directly authorised. Now the nice thing is, day to day, we deal with slightly more complex circumstances than perhaps a run-of-the-mill broker. That sounds rather pompous, but that's kind of how we pitch ourselves. It's specialist lending. We'll go through today just a number of areas, touching on what we discussed a few moments ago with the accountants, limited company versus personal, working out return on investment. So at the moment, house prices are quite high, rents are increasing, but not significantly. And it's how you maximise your return on investment overall. So looking at the positives of buy-to-lets, the accountancy side of things and the tax is the reality, but actually how you grow your portfolio, how you build wealth to get into a position that you actually pay tax. I think that's the way we look at it. So, and then you can look at how to mitigate tax. So my side of it is looking at how we can grow, how we can develop, how we can add revenue streams, how we can add wealth to our net worth. So we'll talk about bridging finance. So bridging finance is a bit of a myth when it's expensive. It's a means to an end. So we'll go through that in slightly more detail. Development finance, holiday lets, multi-unit freehold blocks. There's lots of things we can go through, but I'll focus on two areas in particular. Limited company versus personal name, what the lending looks like, return on investment, and bridging finance, because that's a way ultimately you can develop your portfolio if you're stuck in terms of you've got your portfolio at the moment and you don't know how to take it to the next level. We'll look at areas there. So, been through who Private Finance are. We've been going quite a long time. I'm one of the directors in our office in Shrewsbury in Shropshire. The buy-to-let market, look, it's changed drastically in the space of 3 months. It's crazy how much it's changed. So before Christmas, you could get a 5-year fixed at 1.2, 1.3% at 60% loan to value. Now you're looking at more like 2.7%. So, and it's probably going to plateau whilst the Bank of England base rate has gone up to 1.25%. Lenders have increased their margins. What will happen as the property market quietens down a little? We expect the lenders to reduce their margins slightly, potentially. Still no minimum income requirement. So if you are professional landlords and you've been sensible or mitigate your tax liability, you're concerned that you can't get a mortgage, or you've got another half, for example, that's not working, got no income, you can still get buy-to-lets with no income. So if you're new to it, you can look at that. Interest only. We'll look at interest only versus capital repayment. So are you looking for a revenue stream, or are you looking to build your overall wealth over a period of time? So I'm quite fortunate, we've got quite a large property portfolio. For me, I have a job day to day. I don't need the income, but I need a decent pension to run alongside the pension that I'm paying into at work. So diversify my portfolio. So everything we do is on capital and interest. So we know every single month the debt's coming down, our portfolio is increasing, and working that way. So we'll look at that. No maximum age with some of the lenders. So you can go to Leeds Building Society and you can take a 40-year mortgage at age 80 years old. So again, if you're looking for somebody who's, for example, they're looking for a bit of revenue on side of what they've got at the moment and want to release some money from that property to give to their family before they pass away, for example, they're in a position then to look at their return on investment. So get a little bit of an income from a property that was previously unencumbered, and maybe reduce the amount of income they were getting, but they've passed it on to their family members. So what do rates look like at the moment? So buy-to-let starting 2.7%, that's the market leading at this moment in time, which sounds quite punchy, but when you look at it, realistically, it's still ridiculously low. And limited company lending, so what's happened just recently, limited company lending versus personal name, it's kind of tightened up. And what we've noticed is a lot of the smaller building societies have shifted into limited company lending. People like Hinckley and Rugby, Family Building Society, which is a huge, huge step in the buy-to-let market. So previously, it was a lot of specialist lenders, they used to be known as subprime, securitized lenders. Now it's a lot of smaller building societies that are moving into that field. So what we've noticed, it's quite fair now in terms of the arrangement fees that some of them charge. So it's only happened really over the last 6 months or so. Again, that will be down to, I was discussing in the back, difference between how a high street bank is geared. Generally, it's something called swaps rates or Bank of England that they're borrowing their money from. Whereas a building society, they're a mutual, their money's from their savers. So they're expecting a decent return on their investment as a saver. So what building societies have had to do is think more creatively of how they can get money out of the door, compared to a bank just farming a mortgage out at 1%, 1.5% getting the money from Bank of England. farming it out. Building society has been a lot more creative recently. They're in development finance, self-build, and then into expats, anything where they can get a bit of a premium. So if you look, limited company buy-to-let getting 3.49%, in a building society's eyes, that's a premium. So they've moved into that market as well. So, which again is opening up the market more so to limited company as a result of, 18 months ago was the last tax benefit you had where you could write off the interest as a tax deductible cost. So all of a sudden, new landlords are thinking of how to mitigate their tax liability. I think what's important about buy-to-lets is that if you're coming into the market retrospectively, you're educated on tax, you're educated on mortgages, how things are looking, what the horizons look like. George Osborne really cocked it up for landlords historically. So moving forward, it's about how you calculate it to get it right. So family investment trusts, limited companies. And I think that will work better this evening rather than retrospectively thinking about what's happened. You look at how you can grow your portfolio moving forward, how you work with trusts, how you work in limited company, how you can take your money out of that company. Do you leave it in there and just pay corporation tax and build your wealth up within that company? So don't take any drawings from it, grow up another deposit to buy another property. So that depends on your own investment strategy. Limited company versus personal aim. For me, in the industry, the biggest difference, not just rate, is the amount you can borrow. So what's changed in lenders' eyes to make sure that you can pay your tax bill is the stress testing. So my first buy-to-let mortgage, 2005, it was with GMAC RFC, if anybody remembers them. It was as long as you got £125 rent a month and the mortgage payment was £100, you get a buy-to-let mortgage, for example. Very little stress testing. Since George Osborne's change, 2016, the PRA met and said to one of the regulatory bodies, we need to make sure that they can pay their tax moving forward. So all of a sudden, lenders changed the way that they stress tested buy-to-lets. So if you're buying in decent areas, a buy-to-let, £200,000, for example, the rental income isn't significantly higher than ex-local authority, 70,000 that you used to be able to get and get 550, for example. You couldn't really get decent borrowing on them because they cap out on the stress test. So what I mean by that, if you look here, that's quite a good example. Like for like in your personal name. So you can see how a lender would stress test on a personal name 4.5% and 145%. So that meant in your personal name, if the rent was £650 a month, you could borrow roughly £120,000. Yep. So if you're buying a house even at £300,000, you've got to put in a hefty deposit. Whereas with a limited company, all of a sudden you can borrow more because of the tax benefits of that. So there's more in the eyes of the lender, a little bit more wiggle room from the tax side of things, so people are able to pay their tax at the end of the year. Yeah. So moving forward, if you're buying in certain areas, particularly in London, for example, you can't get away with buying a buy-to-let in your personal name unless you're anywhere south of really Birmingham or here. You can't really buy buy-to-lets and get decent leverage without it being in a limited company because the stress testing isn't strong enough. Does that make sense? So hopefully that explains why, just from a very basic viewpoint of why limited company is useful for gearing, for getting debt out of a property. What we'll look at here is return on investment. I think this is really important at the moment as yields tighten up a little bit. Yields are only important if you're a cash buyer. If you're a cash buyer, a yield is important because you know you put your £200,000 cash down, you're going to get £750 a month on it, for example, you know your yield. In my eyes, my generation, slightly longer, you need a bit of borrowing to get things to work. And that's where you work on return on investment. So here, and it's pretty self-explanatory, hopefully you can see it. It's better than me kind of run it through and talking you to death. But a yield in this instance, £200,000, £750 a month, would be 4.5% before your tax, before your other costs. So reasonable. For the amount of work you're putting in, it's okay. If you look at return on investment, and again, take the tax advice on the other side of it, so gearing up your property and looking at it here with all of, when we talk about return on investment, it's your deposit, your stamp duty, your buying costs, and what you've actually physically invested into that property to buy. Yep. And the rest you gear up. Ignore the mortgage side of things, really, in truth, because that's the means to get you there. So here you work on return on investment. So all of a sudden, you've deposited less money into to buy it, mitigated your risk, so you could buy 2 properties in different areas. If on a street you've had a murder, for example, your house is going to go down in value by God knows whatever overnight. By mitigating your risk, you can buy in different areas. And mitigating your risk is by taking debt. So working return on investment is for the period that you take the mortgage. It's very difficult to do it beyond that. So it's quite a short-sighted view, but at the moment you could take a 10-year fix pretty much for the same money you can take a 5-year fix for. So you could work on your return on investment to a degree for a 10-year period. Yep. So reducing, the key points here for me to point out is to say that reducing, by increasing your debt on your portfolio, you're actually reducing your risk, in my opinion. You're mitigating your risk across your portfolio. Any questions on that first of all? I think it's better to go through it whilst we go through rather than questions at the end. You kind of forget. Is there anything there you'd like to pick up on it or challenge me? No? Good. Bridging finance is a big one, particularly in the current climate, a huge one. And there's this myth that bridging finance is expensive. And it's expensive from the wrong people. And what I mean by the wrong people, bridging finance generally is unregulated. It's a non-regulated market. If we put all of our money together in the room tonight, we could become a bridging lender tomorrow, set up a website and become a lender. So that's where you see expensive bridging finance. I mentioned before at the start of this that building societies and private banks are finding ways to get money at this moment in time, get money through the door and money out of the door. So they're into bridging finance, they're lending to expats, they're lending to limited companies that I said before. So bridging finance, I've just done one this week with Lloyds Private Banking at 2.25 over base. So, and that's on £1 million. And that's to be able to move a little bit quicker. Bridging finance, typically, if we were to go to Harpender Building Society, it's probably 5.19% with a 1% arrangement fee. You only pay interest for the period that you have a bridging loan. So if you only have the bridging loan for 1 month, it's 5.49 or 5.19 per annum. You've paid your 1% arrangement fee, of course, because if you only have the debt for 1 month, the lender's not going to make any money. So that's why you have higher arrangement fees. And then you pay per month that you have the loan. What it's useful for, so this is where landlords have got opportunity in the current climate. With all of these changes that are making it horrific, if you like, for landlords, but you've got to, depending on how you look at it, there might be opportunity there. So EPCs in particular are a big one. People don't have the money to be able to upgrade, to tidy them up, so they can't be let out. Particularly if it goes to, I think, is it going to be a C in 2026 is the aim. So there's opportunity there if you get your model right. Well, speed to complete. So in the current climate, you might find something that's amazing. You just haven't got the time to sell another property or to release money from investments. I think that's the biggest one for me, is releasing money for investments. The stock market's down, 20% in the space of 6 weeks. So most people aren't going to touch their St James Place wealth management and take 20, 30,000, 100,000 out of that, because why would they? So we look at other ways to release funds and to complete quickly. So rather than being a cash buyer, we can still be cash. Estate agents hate to hear this, but release it from another asset by way of bridging finance, so you've got the funds to be able to complete quickly. Complex transactions, so splitting up assets actually is a brilliant thing. So we did one down in Bath not too long ago, a gent buying a row of HMOs, and it had land on the back that he wanted to do a subsale on straight away. So we'd already got a buyer for the land for development finance on the back, and we did it in it's called a subsale, splitting titles. Sounds really complex, but actually if we go to a mortgage provider, they're like, no, we can't do that. But actually what we did in this instance, really, really smart. It's a professional rugby player, really, really well known, really smart in property. He had a row of HMOs. That's all he was interested in Bath, but it had a development plot on the back. We actually did a subsale on the day that he completed to release the deposit from the land to buy the HMO. Amazing. It was the most amazing transaction. And these things happen. These things can happen, but you've got to be smart and know how to do it. These property seminars that you see, usually where you pay £10,000 to go to. I can help with that without having to pay it. The problem is a lot of the time it's nonsense what they're looking to do and can't be done. There's angel investments and other things, but actually we can work with you, set out a plan on actually how you can grow your portfolio properly. Not overgear yourself, of course, and cripple yourself, because banks actually don't allow you to do that, despite what you think. Bridging finance, I'll explain how it works, just so you know. You don't service debt with bridging finance. They give you the interest as well as the debt. So let's say you need a net loan of £100,000 to complete on a purchase. The bank actually give you a net loan of 100,000 plus 12,000 for the interest for the year. So you don't pay any monthly payments once you have the loan. So when you've sold the property, or whatever you do with the property, or refinance it, you pay the net loan back plus the interest for the period that you've had it that they've already given you. Yep. So again, you see people who can't afford, think, how on earth can they afford to buy that? Actually, they're not serving any of the interest. The caveat, as always, with bridging finance and whatnot, but I've got conscious on time, sorry, I'm going over. How can I grow my portfolio? We'll finish on this one. This is really, me personally, it sounds rather arrogant thing to say to talk about me, but it shows it can be done and how to work. So this hasn't come without its problems. So I put at the moment, and I stress time is valuable. You forget when you're going down to a house to rip things out. I do it for stress management. Actually, if you valued your own time, the projects don't always become that cost effective. This here, excuse me, I purchased the property for 180,000 in May last year. Stamp duty was 5,400. It was actually less at that time because it was the stamp duty holiday. But I was trying to work out what it was when I was doing this presentation. I took a bridging loan in this instance with Shawbrook Bank. And Shawbrook, they gave me the loan to complete. I think it was about 70% gross, so including the interest. But I also had the renovation costs given to me in arrears throughout the build. So I had to pay for the first phase to increase the value. Then the funds were released back to me to put till the next stage. And they just do a re-inspection to make sure it's increasing in value. The interest, it was, because it was quite a small loan, it was about 0.8 a month, so not that attractive, but okay for what I was looking for. And they were giving me the renovation costs in arrears. So the total cost of this project cost me 297,000. Yep. And it valued at 375. I think it's worth a little bit more because it's got a garage on the side like we all do. With our houses, always think they're worth a bit more. So I refinanced out of this with Cumberland Building Society in a limited company, 275,000. I think it's really important. If I bought this property at 400,000, a 25% deposit would have put £100,000 in to buy it, dead money, gone. And then I would have been getting my rental income from it. In this instance, I've built the deposit by working on the property, refinanced out. This property's cost me about, let's say 25, 30,000 in total after I've refinanced out. It's not highly geared because the rent on it's really strong. But this is a living example of it works. And this is where the opportunity coming up. I think the market taking a bit of a turn, and it's ruthless. It's absolutely ruthless to think like this, but there's going to be people that find it difficult offloading properties because they're not quite comfortable with the tax position, not able to afford their tax. They might just changing lifestyle, retiring, lots of things. And I do think that's where the market is shifting. You can feel it when we're seeing it as from a mortgage point of view. We're refinancing people that took a mortgage rate at 1.5% 2-3 years ago, and now they're looking at 2.7%, and it's £500 a month more expensive, and they haven't got it. So all of a sudden they're thinking, well, what do I need to sell? What do I need to get rid of? So I think it's a case of preparing yourself, in my opinion, of actually a little downturn in the market. All of the negatives around the tax side of things, as long as you're focused and plan, I think, moving forward of the tax, the interest rates, everything like that, and you plan it properly, you shouldn't plan to fail. We're failing at the moment because of historic changes. Knowing what we know moving forward, you should be okay. So that's, I think, a good example, but more, in my opinion, a working life example, rather than that I've actually done. I've got pictures I can show you after of what it looked like, of what it looks like now, and that should give you some comfort that it is doable. I'm not particularly intelligent, I just happen to fall on a bit of a diamond there. There's loads of other types of finance, and I'm kind of already over my time. I'm sorry. Loads of other things we could talk about. Holiday lets, in particular HMOs. Holiday lets being really tax efficient. HMOs is a big one that Dawn wanted me to pick up on. But after, if you want to chat to me on how we can look at financing things, come and pick my brains. But there's some of the things that we do, and of course standard residential lending as well. And then, like anything, a caveat at the end, so your home could be repossessed. Are there any questions there? It's kind of hammered and talked so fast, but is that okay?